In this video, I want to talk about why saving your first $10,000, or maybe a little more, is probably the single most important step on the path to financial independence. I'll explain why growing your capital after that is so much easier from a mathematical point of view. And I'll also share my own experience and how, thanks to relatively small initial savings, I was able to completely change my life. Charlie Munger, the billionaire investor and Warren Buffett's right-hand man, once said that saving the first $100,000 is incredibly difficult, but you have to do it. I don't care what you have to do, he said, if it means walking everywhere and not eating anything that wasn't bought with a coupon. Find a way to get $100,000. Now, $100,000 is a huge amount of money for many people. So in this video, we're going to talk about, let's say, your first $10,000. But the exact number isn't what's important. It's the principle. That first big chunk of savings is the hardest to get, but it's also the most important. We'll look at this from a mathematical perspective, and that's probably the main part of this video, but I want to start with the psychology. And from a bit of a personal angle. Recently, I was discussing with a colleague how difficult it really is for most people to start their own online business, or even just switch to a potentially more profitable field, precisely because they have no savings. You can see this perfectly with a YouTube channel. When I started my channel in the first 6 months, I made 22 videos. I tried to pick the most interesting content, with links to statistics, market research, scientific papers, and so on. During that time, my channel only got 400 subscribers. And the profit from such a channel was, of course, zero. There wasn't even money on the horizon. Meanwhile, YouTube was taking up a ton of my time. And if I had been working a full-time job at the same time, the quality of the content would have been even lower. Instead, I was able to just live off my savings. And in that sense, the difference between having zero in your bank account and having at least, say, $10,000 is infinitely greater than the difference between $10,000 and $20,000. So you could say that even though I didn't invest any money into the channel's growth, part of its success is still explained by the fact that I had savings to get started. If you are financially constrained, you are also constrained in your earning potential. Because you don't have enough flexibility. You can't afford to calmly spend 6 months learning a new skill or field that, of course, won't pay you anything at first. And this doesn't just apply to business. Statistics from various sources show that people who change jobs periodically, on average, see higher income growth year over year than those who stay in the same place for decades. To have this flexibility and peace of mind, it's crucial to save as much as possible, as early as possible. And that's why it's much more beneficial to have an extremely high income in the early stages of life, even if it gradually decreases, than to earn a flat average salary your entire life. And that's why I'm putting so much effort into earning a high income now in my youth. Anyway, let's continue. We were talking about how important it is to build at least some capital in your early youth, because that flexibility, in turn, can help you increase your active income. I'll also note that after you have those first savings, the return on your portfolio can also increase, which makes subsequent growth even easier. As a rule, until a person has saved enough to cover at least 6 months of living expenses, they only use extremely conservative safe instruments, like high-yield savings accounts, TIMECODES, or government bonds. But after that first, say, $10,000, you can definitely move on to riskier investments, if your risk tolerance allows it. Stocks, real estate, and so on. But there is another primary reason why the first savings are always much harder than the rest. Compound interest. The easiest way to explain this is with this visualization of portfolio growth. Here, we'll assume very small contributions, just $1,000 per year. Our goal is to save $100,000. We'll assume a 7% annual return. And we can say this is a real return. So 7% above inflation, like you might get from the US stock market during a good period. This means the $100,000 goal here is in today's money. Now, notice the timelines. To get the first $10,000 at this rate, it will take almost 8 years. At this stage, 78% of your capital comes from your own new contributions. On the next step, things change. The second $10,000 is reached in just 5 years. And half of it is from our contributions, while the other half is natural growth. Growth is already playing a much more significant role. And the further you go, the less your contributions matter. If a person has already saved $50,000, 80% of their portfolio's growth now depends simply on its returns, not on how much new money they add. At this point, you could basically stop saving, and the portfolio would just grow by itself. This again shows why it's so important to save that initial capital as fast as possible. The need to provide for yourself after you stop working can be seen as a debt to your future self. And the sooner you pay it off, the less interest you'll have to pay. And consequently, the less you'll have to work to pay off that debt. Here's a concrete example. Imagine someone who, by age 25, has somehow managed to save $30,000. If they invest this money in stocks, bonds, or maybe buy a very cheap property to rent out and reinvests all the profits, even if they never add another dollar to their retirement portfolio for the rest of their life. By retirement, they will still have over $210,000 in today's money. This assumes a real return of just 5% per year. In this case, they could provide themselves with a passive income of around $700 a month and still leave an inheritance, all thanks to just $30,000 that they saved when they were young. But most people start thinking about retirement savings much later, at 45, in the best-case scenario. So let's compare. In that case, to build the same nest egg by retirement, they would have to save $6,100 per year for 20 years. In total, they would have to invest over $120,000 of their own money. I'll remind you, that's instead of the $30,000 they could have saved in their youth. Imagine this wasn't a debt to yourself for some future pension, but a mortgage. Everyone would rush to pay off that loan as fast as possible, right? It's much better to pay $30,000 than $120,000. That's an insane overpayment. It's a nightmare. Who would want to overpay by 4 times? And yet, of course, many people do. Because in your youth, you don't really want to work for some ephemeral pension 40 years away. And you know, earning money is often harder when you're young. I've paid off my own debt, so to speak, and then some. If I were happy with an excellent pension by, say, Eastern European standards, by age 50, I could stop saving right now. I am almost guaranteed an early retirement just because of how early I started saving. You just have to pedal really hard at the very beginning, and then the bike will coast to your destination on its own. Of course, in reality, I don't plan to stop because I want a much higher level of spending. And, well, I'd like to have the option to not work by age 40, not wait until 50, and to do useful things as a hobby, without paying any attention to how much money my active work brings in. So, of course, I continue to invest new funds. Besides, money isn't earmarked just for retirement. You can spend savings on other things if you absolutely need to, knowing that if something goes wrong, you have a financial reserve for several years. That gives you significant peace of mind and that flexibility I mentioned at the beginning. So you're actually getting a benefit from your capital even when you're not spending it. This is also closely related to the concept of the time value of money. This is a concept that says money received today is always more valuable than money received in the future. If I tell you, for example, that you can have $10,000 today, or the same $10,000 adjusted for inflation in 5 years, you will almost certainly choose to get the money today, because you can immediately invest it and have more in 5 years. This concept is one of the reasons why interest on bank deposits, debts, and so on even exists. It's compensation to the lender or investor for the fact that they can't use their money right now and are forced to wait. And the further into the future we look, the cheaper $100 becomes. And again, I'm not talking about inflation. This works even with inflation-adjusted numbers. It's just that almost any person prefers to have a benefit today rather than many years from now. This premium for waiting is a fantastic opportunity for those who value future money almost as much as present money, for those who can easily be patient for the sake of their own good future. Thanks to this, we can effectively buy $100 bills today for, say, $20 or $30, with the only catch being that we'll receive them in a couple of decades. I had a video on my channel a while back about why compound interest won't make you rich. And it's true, beginner investors often overestimate the final result. You're unlikely to multiply your investment 100 times, even in your entire life, and you're definitely not going to be the next Warren Buffett. But, if you start investing as early as possible, you will have to put in several times less effort than those who start right before retirement. The most important and, at the same time, the hardest part is taking those first steps. After that, a couple of thousand you set aside today can naturally turn into a couple of 100,000, which will be enough for the rest of your life. That's all for today. I hope that was interesting. Here's the next video, and thanks for watching. Thanks for watching. Please like if you found this helpful, leave a comment, be sure to subscribe, and share this video. You can find useful links in the video or channel description. See you soon.